Natural gas prices have declined significantly in the past year due to a combination of factors, such as rising output, low demand, and geopolitical tensions. In this section, we will explore how these factors have affected the natural gas market and how some exploration companies have responded by reducing gas production, especially in the Haynesville Shale region. One of the main drivers of lower natural gas prices is the record-breaking output in the United States. According to data from Refinitiv, average gas output in the lower 48 states held at 101.4 billion cubic feet per day (BCFD) so far in May, matching the monthly record hit in April. The increase in production was mainly driven by the growth of shale gas, which accounted for about 70% of total gas output in 2022. However, the high output was not matched by high demand, which led to an oversupply of natural gas in the market. Demand for natural gas was dampened by several factors, such as mild weather, lower economic activity due to the pandemic, and increased competition from renewable energy sources. According to the International Energy Agency, IEA, global natural gas demand is expected to remain flat in 2023, with modest growth in the Asia-Pacific region offset by projected declines in Europe and North America. Another factor that contributed to lower natural gas prices was the geopolitical crisis between Russia and Ukraine, which disrupted the supply of Russian pipeline gas to Europe. Russia is the largest exporter of natural gas to Europe, supplying about 40% of its needs. However, after Russia invaded Ukraine in late 2022, it reduced its pipeline deliveries to the European Union by 80% over the course of last year. This created a shortage of gas in Europe and pushed up prices to record levels. In response to the high prices in Europe, liquefied natural gas, LNG, exporters diverted their cargoes from other markets, such as Asia and North America, to Europe. This reduced the availability of LNG for other regions and increased global LNG prices. However, as Europe exited the winter with record levels of natural gas storage, LNG imports declined and prices fell sharply. The decline in natural gas prices has put pressure on the profitability of exploration and production companies, especially those that focus on dry gas production. Dry gas is natural gas that contains little or no liquids or other hydrocarbons that can be sold separately. Dry gas producers have lower revenues and higher costs than wet gas producers, which can sell liquids such as ethane, propane, and butane at higher prices. One of the regions that has been hit hard by low natural gas prices is the Haynesville Shale region, which spans parts of Louisiana, Texas, and Arkansas. The Haynesville Shale is one of the largest sources of dry gas in the United States, producing about 13 BCFE in April 2023. However, due to its high break-even price of around $2.50 per million British thermal units (MBTU), many Haynesville producers have been losing money at current market prices. As a result, some exploration companies have decided to reduce their natural gas production in the Haynesville Shale region. According to data from Baker Hughes, the number of active rigs drilling for natural gas in the United States fell by 10% from April to May 2023. The decline in rig count indicates a lower level of investment and activity in the natural gas sector. The reduction in natural gas production has helped support prices by tightening the supply-demand balance. Natural gas futures rose nearly 5% to their highest in 2 weeks on Monday on concerns over a decline in future production. However, the outlook for natural gas prices remains uncertain and subject to various risks, such as weather conditions, LNG availability, and geopolitical developments. In this section, we will explore how natural gas futures have rallied after a sharp drop in the number of active drilling rigs, suggesting a slowdown in production activity and how this has affected gas-focused equities. Natural gas futures are contracts that allow traders to buy or sell natural gas at a predetermined price and date in the future. They are influenced by various factors, such as supply and demand, weather, storage levels, and production trends. One of the key indicators of future production trends is the number of active drilling rigs in the EU, which reflects the level of investment and exploration activity by energy companies. Drilling rigs are machines that create holes in the earth to extract natural gas or oil. According to Baker Hughes, a leading oilfield services company, the total active gas drilling rigs in the EU sank by 16 to stand at 141 in the week ending May 12, 2023. This was the lowest total since April 2022 and the biggest weekly decline since February 2016. The gas-directed rig count has also fallen below year-ago levels for the first time since 2020. This sharp drop in drilling rigs suggests that energy companies are scaling back their production plans amid low natural gas prices, which have been mired near two-year lows due to warmer weather and abundant supply. Lower production activity could lead to tighter supply and higher prices in the future, especially if demand picks up during the peak summer or winter seasons. This expectation of a slowdown in production activity has boosted natural gas futures prices, which rallied nearly 5% to a two-week high of $2.375 per million British thermal units (MBTU) on May 15. This was also supported by forecasts for cooler weather and higher heating demand in some parts of the EU. For the next 2 weeks, the rise in natural gas futures prices has also lifted gas-focused equities, which are stocks of companies that produce or distribute natural gas. These stocks tend to follow the movements of natural gas prices as they affect their revenues and profits. Some of the top performers among gas-focused equities on May 15th were EQT Corp, NYSE, EQT, which gained 5%, Southwestern Energy, NYSE, SWN, which rose 4.2%, Range Resources, NYSE, RRC, which increased 3.8%, Antero Resources, NYSE, AR, which advanced 3.8%, and Coterra Energy, NYSE, CDRA, which climbed 3%. These companies are among the largest natural gas producers in the EU, with operations mainly in the Appalachian Basin. In summary, natural gas futures have rallied after a sharp drop in the number of active drilling rigs, suggesting a slowdown in production activity and how this has affected gas-focused equities. This trend could continue if natural gas supply remains tight and demand recovers in the coming months.